Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review, where I talk about current events for the everyday investor and homebuyer. Our topics for this week: topic number one from Corelogic on the 12th of September. New Zealand property market faces mixed fortunes as recent slowdown hits suburbs. Second topic from One News on the 10th of September. More than 300 Kāinga Ora projects across New Zealand in limbo. Topic number three from RNZ on the 11th of September. Rateable values, market values, and rates. What you need to know. Topic number four from RNZ on the 12th of September. Mortgage brokers, which are now called mortgage advisors, push back on Commerce Commission advice to present multiple offers. Topic number five from RNZ on the 10th of September. Glut of houses on the market, keeping values down. QV. Topic number one from Corelogic on the 12th of September. New Zealand property market faces mixed fortunes as recent slowdown hits suburbs. Property values across many New Zealand suburbs have recently weakened, with a noticeable slowdown over the past 3 months following an initial rise in 2024. CoreLogic New Zealand's latest data reveals that while 50% of suburbs experienced meaningful increases in the past year, a sharp decline has occurred recently, especially in Auckland, Napier, Wellington, and Nelson. Calvin Davidson, Chief Property Economist at CoreLogic New Zealand, reported that 480 out of 951 suburbs saw a median property value increase of at least 1% since September 2023. Despite this, he noted a clear slowdown, particularly in Auckland, where areas like East Tamaki and North Park experienced drops exceeding 6% over the last 3 months. Davidson described the past year as having two distinct phases: a recovery in late 2023 and early 2024, followed by a downturn in recent months. He emphasised that rising affordability pressures, increased property listings, and growing job insecurity have created a more cautious market environment, leading to falling values in 71% of suburbs since June. While some suburbs, like Cobden and Blaketown and Grey District, posted double-digit annual gains, the recent downturn affects both affordable and high-value areas. For instance, Auckland's Herne Bay remains the country's most expensive suburb at $3.38 million, but the city overall has seen widespread value declines, with 183 suburbs affected in the past 3 months. Hamilton, while showing resilience over the past year, has also begun to feel the effects of the broader market downturn, with 27 of its 35 suburbs experiencing value drops since June. Tauranga and Wellington have shown similar trends, with declines recorded in the majority of suburbs since mid-2024. Christchurch and Dunedin, which initially held strong, are now seeing slowdowns, with many suburbs reporting value declines in the past 3 months. Davidson suggested that while falling mortgage rates might provide short-term relief, a swift rebound in property values is unlikely. Affordability concerns and job insecurity continue to weigh on demand, and market conditions are expected to remain subdued into 2025. He anticipates that vendors who don't need to sell may hold off, while buyers face challenges navigating a competitive lending environment. My thoughts on this are that we've got quite a stable property market at the moment. There's a lot of new listings coming on board, but there's also an increase in the number of sales that we're seeing. So, there seems to be a bit more urgency in some of the buyers that are entering the market at the moment. But I would suggest there's still plenty of opportunity for you to negotiate a really good purchase price. So, there is no need to feel rushed into purchasing in the current market conditions. Topic number two from One News on the 10th of September. More than 300 Kāinga Ora projects across New Zealand are in limbo. Over 300 social housing projects across New Zealand are on hold, while Kāinga Ora assesses their economic viability, One News reports. The government initiated a comprehensive review of the Public Housing Agency in May, after a report found it was not financially viable. The report projected operational deficits to grow from $520 million in 2022 and 23 to over $700 million by 2026-27. One affected project involves a planned 24-home development in Gore, where $2.5 million had already been spent before it was paused. Another $24 million had been invested in land preparation for a site in Auckland. Vanessa Cole, a campaigner from Action Station, emphasised the urgency of the situation, noting that families in both regional and urban areas desperately need the homes that were scheduled to be built. As of July 31st, 371 Kāinga Ora projects were under review, with only 48 moving forward, leaving 323 in limbo, despite $293 million having already been spent. Housing Minister Chris Bishop described the review process as business as usual, noting that managing 72,000 homes and various construction activities involves continuous assessments. He suggested that some projects may be redesigned rather than cancelled to address financial concerns, especially in areas with significant housing needs, such as emergency housing zones. Despite these reassurances, Labour housing spokesperson Kieran McAnulty criticised the delays, arguing that it's not typical for Kāinga Ora to halt building. He also pointed out that reviewing the projects could end up costing more than proceeding with them. Cole warned that the delays not only affect families awaiting homes, but also harm the construction sector. Bishop, however, maintained that the assessments are essential to ensure value for taxpayer money, although some projects may take longer to complete. If you'd like to learn more about investing in property, join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as a financial advisor, available live online or in person. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and would like to find out more about how we can help you to reach your financial goals, you can also book a no obligation phone call or meeting with my husband, Paul Roberts, via the website propertyapprentice.co.nz. Topic number 3 for this week in review from RNZ on the 11th of September, rateable values, market values and rates, what you need to know. Councils across New Zealand are updating rateable values, or RVs, a 3-yearly assessment of property values used to determine local rates. In regions like Auckland and Wellington, where RVs were set when house prices peaked in 2021, significant reductions are expected. However, even if RVs decrease, rates are likely to continue rising in many areas. RVs provide a snapshot of property values and help allocate the total amount of rates a council collects, but they do not affect the overall amount raised. As Brad Olson, CEO of Infometrics, explained, RVs determine how the rates pie is divided, not its total size. Properties that have seen greater fluctuations in value will pay a larger or smaller share of rates accordingly. The updated RVs will be made public in December and used to calculate rates from July 2025. Homeowners who disagree with their new RV can challenge it within 6 weeks of release. Traditionally, RVs were seen as indicators of market value, but Chris Fahey of Bailey's Realty Group noted that their importance has diminished, especially after the housing market dropped from its 2021 peak. Some regions, particularly Auckland and Wellington, are expected to see significant reductions in RVs. However, some sellers still rely heavily on RVs when considering offers, which can complicate the sales process. RVs are made up of 3 components: capital value, which is the property market value, land value, the value of the land alone, and improvement value, the value added by structures on the property. Renovations not captured by building consents aren't included in the valuations. So what we're talking about there are things like cosmetic renovations, like, landscaping, carpet replacement, wallpaper replacement, or painting the inside or outside. State-owned Quotable Value Limited, or QV, handles the RV assessments for many councils. QV's process includes market analysis, inspections of property sales, and updates from building consents and subdivisions. The Office of the Valuer General audits QV's work to ensure accuracy. You will note that in some parts of New Zealand, they're not called RVs, they're called CVs or GVs. It's all talking about the same thing, but it's not an accurate estimation as to what the current market value of a property is. If you want to find out what the current market value of your property is, you need to look at what recent properties that are in similar condition, similar size, similar land value, land size, sorry, see how much they've sold for recently in your area and compare that to your property to give you an estimated market value. Topic number 4 from RNZ on the 12th of September. Mortgage brokers, or mortgage advisors as they're now called, push back on the Commerce Commission advice to present multiple offers. Mortgage advisors are concerned that a Commerce Commission recommendation requiring them to present borrowers with at least 3 bank offers may complicate the lending process. The Commission's final report on the banking sector suggests mortgage advisors should encourage price competition by presenting clients with multiple offers and disclose which banks they can't work with or where better rates might be available. This comes as about 2/3 of new home loans are now handled by mortgage advisors compared to less than 30% in 2014. David Cunningham, CEO of Squirrel, criticised the proposal, calling it a solution in search of a problem. He noted that advisors already engage with different lenders daily and monitor bank credit policies to determine the best options for clients. He warned that requiring 3 offers could significantly delay loan approvals, as lenders would need to perform full credit assessments even though they'd secure the loan only 33% of the time. Cunningham predicted this would slow the system without enhancing competition. Loan market advisor Karen Taddison agreed, emphasising that a good initial consultation allows advisors to determine the most suitable bank. She pointed out that interest rates are usually similar across banks, and the focus should be on finding the right loan product for the client. Taddison added that requiring 3 offers could overwhelm advisors and reduce service quality, undermining their role in providing personalised advice. Massey University banking expert Claire Matthews echoed these concerns, arguing that the additional workload would not add value. She suggested that lenders might stop working with advisors if they're merely used to fulfill the requirement for multiple offers. And I think that's a valid point that she makes there. So my thoughts on this are that putting a loan application together does take a significant amount of time. It is improving with some of the relaxing rules around the CCCFA, which is the Credit Contracts and Consumer Finance Act, which is now no longer catching banks in the same way as it used to. So, I think mortgage advisors do work with their clients' best interests at heart. And sometimes there might only be one option available for a particular client. So, that trying to get them 3 pre-approvals for lending when they might only qualify for lending with one particular bank, how are you going to do that? Topic number 5 from RNZ on the 10th of September, glut of houses on the market, keeping values down, QV. National housing values continue to decline with an oversupply of properties helping to keep prices low. According to the latest QV House Price Index, the national average home value dropped 2% in the 3 months ending in August compared to the previous year, though it saw a slight increase from the preceding 3-month period. The average home is currently valued at $905,357, relatively unchanged since the beginning of the year. James Wilson, QV's operations manager, attributed the stagnant housing market to economic challenges like rising unemployment, credit constraints, and high interest rates. While interest rates have started to ease, the large numbers of homes on the market is keeping values suppressed. Wilson noted that house values will likely increase again once the surplus of available properties declines, though this could take some time. Larger cities experienced the steepest declines, with Auckland values down 2.8% and Wellington down 3%, marking the 7th consecutive month of negative growth for the capital. Other cities, including Hamilton, down by 1.7%, Tauranga down by 1.5%, Christchurch down by 1.3%, and Dunedin down by 1.1%, also saw drops. Wilson highlighted that the abundance of listings, especially in major cities, will continue to limit home value growth, despite a growing number of buyers showing interest as spring approaches. He described the current buyer sentiment as cautiously optimistic, with many believing the worst of the market downturn may be over. Spring traditionally signals the start of the selling season, and Wilson anticipates more investors will list properties following changes to the Bright Line test in July. We'll see. I'm not so convinced about that unless the investors need to sell those properties. If they're planning on selling it at some stage, my guess would be that they'd wait until values picked up significantly for them to do that. Sellers who previously withdrew their properties from the market might also try again, sensing some renewed confidence amongst buyers. If you're ready to take the next step in your property investing journey, join us for How to Succeed with Property Investing. Learn proven strategies, gain expert insights, and discover how to make smart, informed decisions in today's market. Whether you're a seasoned investor or just getting started, even looking to purchase your first home, this event is packed with practical tips to help you to achieve your financial goals. During our live online and in-person sessions, I'll also tell you more about how we can help our clients to achieve their financial goals. So if you're interested in finding out more about what we do, visit propertyapprentice.co.nz today and register for one of our upcoming events. If you've already been to one of our free events and would like to know more about how we can help you on your journey, book a no obligation phone call or meeting with my husband, Paul Roberts, through our website. And feel free to tell your friends and family about our free events and encourage them to attend if you enjoyed them as well. Thanks for listening.